Now let me turn to the monetary policy implications in terms of trade shocks. To what extent are those developments I just mentioned relevant for the conduct of monetary policy in the euro area? The European Central Bank's mandate is to maintain price stability over the medium term, and as I say frequently, it is not a self-determined mandate. It is the mandate we have been given by the democracies of Europe. They have themselves decided to give the European Central Banks its mandate. And the price stability is defined, as you know, as a rate of increase in the harmonized index of consumer prices for the euro area as a whole, the 320 million people that are making up the euro area, below and close to 2%. Hence, developments in external prices are relevant for the monetary policy of the ECB to the extent that they have an influence on medium-term deviations from price stability. What are the potential risks, then, to price stability in the medium term coming from globalization? Before addressing these issues and drawing some lessons from monetary policy on the basis of the euro area experience, I would reiterate that reports of the death of the effectiveness of monetary policy in a more globalized world have been, of course, greatly exaggerated. Contrary to 16th century Europe, individual central banks are able to define their medium and long-term definition of price stability. Moreover, as far as usual arbitrage considerations still apply, long-term interest rate determination continues to be closely related to the present discounted value of future expected short-term rates, thus giving a prominent role to central bank credibility and communication. Given that inflation is ultimately, in the long run, a monetary phenomenon even in a globalized world, theories asserting that China is exporting deflation or inflation should be viewed as overly simplistic. Globalization forces materialize as external shocks which should in principle affect relative prices rather than the overall inflation rate in the long run. However, as is often the case in economics, matters become particularly complex when we move to analyze higher frequencies than the long term that I just mentioned. In the medium run, whether terms of trade development, like increases in oil and commodity prices or cheaper manufactured goods imports, exert positive or negative pressure on inflation will depend on their net effect on aggregate demand and aggregate supply. Soaring import prices will in fact tend to produce two competing effects. The first effect, which can be denoted as supply effect, derives from the lower potential output growth associated with an adverse terms of trade shock, for instance, brought about by an exogenous increase in the prices of oil or other commodities which are used as intermediate input in domestic production. Thus, for a given level of aggregate demand, the fall in potential output will tend to be such that actual output exceeds potential, leading to a positive output gap and upward pressure on inflation. There is a widespread perception that commodity prices affect inflation also through demand effects. By impinging on individuals' wealth due to the impact of higher relative prices on current and expected future income, commodity price shocks may trigger a reduction in the demand for goods and services. For given potential output growth, the wealth effect would give rise to excess aggregate supply, thereby leading to downward pressure on domestic inflation. Whether inflation tends to increase or fall in response to an adverse terms of trade shock will therefore depend on which of these two effects dominates. in theory, there is no general result. The net effect will also depend on specific features of the shock, whether it reflects exogenous shifts in the commodity supply or a buoyant global demand for them, and of its transmission throughout the economy. The wealth effect will dominate when aggregate demand reacts quickly. This may be the case, for example, when relative price developments are perceived to be very persistent, very permanent. Conversely, supply effects will tend to dominate when aggregate demand adjusts more slowly. The wealth effect should also be small, thus contributing to building inflationary pressures. Another important distinction, particularly in the present juncture, deals with the ultimate causes of terms of trade shocks, as they can reflect either commodity-specific or more aggregate factors. For instance, for the point of view of large economies like the euro area or the US, an oil price increase fueled by Chinese demand is not the same as one fueled by a supply disruption. The factors underlying increases in Chinese demand for oil can also affect global inflationary pressures in a way that oil supply disruption needs not. But in any case, whatever effect dominates, either supply or demand, both might be dwarfed if nominal second-round effects start to appear in case of the example I gave of a commodity price increase. The disanchoring of inflationary expectations is there threatening to become the dominant factor as soon as price setters and social partners are giving or tend to give a permanent status to the otherwise transitory price increases.